Greetings to all. So this is Dr.K.J. Sunmista, Assistant Professor of Commerce from the Standard Fireworks Rajaratnam College for Women, Sivakasi. I am very happy to present before you the video lesson on the topic Income from House Property. The main learning objectives behind this video lesson is to understand the concept of income from house property and then to learn the steps in the computation of income from house property let out. First, let us see to the concept of what is a house property. Under the Income Tax Act, income generated from house property is subject to taxation. Any land or building which are owned by an individual comes under the house property. It includes the properties like shops, flats, factory sheds, office spaces, even the farmhouses. Rental income from such property is considered to compute the annual value of the house property. The legal owner of the property is liable to pay the tax on this income. Income from house property becomes taxable only if the following conditions are fulfilled. The house property should comprise of building or any land attached to it. The taxpayer should be the owner of the property and the taxpayer should not use it for his business or professional purposes. Here in this case, we can see three types of house properties. One is the self-occupied property which is used by the individual for his own residential purpose. The second property is the let-out property which is rented or hired to another party. And the third type of house property is deemed to be let-out property. That is, these are the properties that are not actually rented and are deemed to be let out. They may be used by the assessee for his residential purpose or for his employment purpose along with another self-occupied property. Now let us come to the main part of our lesson. What is income from house property let out and how to determine it? The annual value of the property is the main thing that we have to compute for determining the income from house property. It can be carried out in two steps. In the first step, we have to determine the gross annual value of the house property, and in the next step, we have to determine the net annual value of the house property. Gross annual value will be the highest value of the following. When the property comes under the Rent Control Act, the standard rent prescribed by the government or the actual rent received by the assessee, whichever is higher will be treated as the gross annual value. And in the next case, when the property is not coming under the Rent Control Act, we have to consider three facts: the municipal value of the property, fair rental value of the property and the actual rent received. Out of these three, whichever is higher will be taken as the gross annual value. If suppose there is vacancy period for any part of the year or for whole of the year and the actual rent is less than the expected rent, then in such a case the actual rent will be treated as the gross annual value. If suppose the house remained vacant for the whole of the year, then the gross annual value of the property will be taken as nil. The second step is determination of net annual value. It can be calculated by the simple formula gross annual value deducted by municipal taxes paid by the owner for that property and unrealized rent. Suppose the house is occupied by the tenant and he has not paid the rent, means that rent is termed as unrealized rent. For the unrealized rent, deduction can be claimed only if the following conditions are fulfilled. That is, the tenancy should be bona fide and the defaulting tenant has vacated the property or the steps have been taken by the assessee to vacate him. from that property, and legal actions are taken against him for recovering the rent amount, then only that amount will be treated as the unrealized rent and we can claim deductions from the gross annual value for computing the required net annual value. The final step is the determination of income from house property. From the net annual value determined from the second step, we can deduct two items. One is the standard deduction and another is the interest which is paid for housing loan. The first deduction is standard deduction. 30% of the net annual value can be claimed as deduction. This is provided for expenses which are incurred for that house property. Interest on home loan. Deduction is available for any interest on housing loan paid by the assessee, especially for that house property. Whatsoever the amount will be, the total amount paid as interest on housing loan can be allowed as the deduction. And moreover, for the pre-construction period interest also, deduction is available in 5 equal installments. But any interest paid on unpaid interest is not deductible. Interest on fresh loan taken for the repayment of original loan is allowed as a deduction. So, by this way, we can determine the income from house property let out. Hope in the next lesson we can discuss on how to compute the value of self-occupied house property and the value of house property which is deemed to be let out. Till that, I am signing off. Thanks to all.